NVIDIA briefly touched about $518 per share after a sweltering Q2 earnings report, but apparently did not please Wall Street enough and fell straight back down like a rock in the following sessions. It has been bouncing around since then and seems to be waiting for its next catalyst. However, that catalyst just may already be here. In this video, I will show you the full tech stack that is putting even the best Wall Street analysts to shame and leaving many investors questioning, it can't keep going up, right? Surely it's only up 300% from its bottom in mid-October 2022. Eventually, it has to stop. Can NVIDIA's H100 chip continue to back its lofty valuation and drive its stock price to new heights? Like some of the biggest NVIDIA bulls are saying, let's find out. For starters, let's not get ahead of ourselves. There are only 5 other companies on the entire planet that are worth more than NVIDIA today. So what does separate companies like Apple and Microsoft, $2 trillion absolute tech behemoths, from the rest of the pack? Well, I think it comes down to 3 things. 1, great financials. 2, a deep competitive moat. 3, recession-proof, top-of-the-line products. These features are all pretty interconnected, so don't worry if you don't understand them all right now. We will go through each one and see how NVIDIA is following in the steps of the 2 tech giants. First thing we have to do is address just how good NVIDIA's Q2 earnings were. And I'm going to throw a whole bunch of numbers at you here, mainly for all the financial gurus. Yeah, this is cool and all, but who cares about all the numbers? Not super important. I'll simplify and explain the ones that you actually should care about.
Gross margin.
The difference between how much it costs to provide the service or build the product and how much you sell it for. Pretty simple, right? The higher this number, the better. After all, one of the primary objectives of for-profit businesses is to maximize profit. And by maximizing gross margins, you are certainly moving in the right direction. Apple retails their iPhone 14 Pro Max at about $1,100, and it costs them less than half of that to make. Microsoft provides cloud services in the form of Azure and Office 365 Suite at a 72% clip. Apple and Microsoft do this better than just about anybody else in the industry, with 44.5% and 69.5% respectively. But NVIDIA sits right above them both at 70.1%, and in their recent Q2 earnings report, they expect this number to grow to 71.5%. Okay, that's interesting.
Growing revenues, limiting operating costs.
Obviously, as a growth company, it is important to ensure that revenues are growing with time, especially in business segments that are growing quickly. It's best to picture this as a pie. As a company obtains more and more of the pie, it has more to eat. More market share of the sector equals more revenue. But what if the pie continues to grow as well? Well, then the higher percentage of the pie you can get your hands on, the faster your piece grows. And this is really what compounding growth looks like. However, just growing revenues, even at an above average clip, does not separate you from the vast majority of corporations. Keeping operating costs low is essential to maintaining future growth. If you can grow revenue fast, but your costs continue to climb at the same or even a faster rate, then your profitability will ultimately decrease. And this is exactly what NVIDIA proved that they do so ridiculously well. Remember the pie example? Well, believe it or not, the overwhelming majority of NVIDIA's total revenue in the last quarter came from data centers. I know we always get caught up in the brand new RTX technology for video games, but this actually makes up a pretty small portion of NVIDIA's total revenue. $13.5 billion last quarter alone, and projected to jump another 18% to about $16 billion next quarter. Their share of the massive data center pie is already massive, but in their latest earnings press release, it just got even bigger. CEO Jensen Huang estimated that NVIDIA has 90% market share in the data center chips designed to handle artificial intelligence workloads in their brand new accelerated computing model. If you haven't heard anything about this generational transition from traditional computing to generative AI and accelerated computing, well, first, I don't think you'd be watching this video, and second, I would recommend watching this video where I break down all that technology in a lot more detail. In short, the old days of computing are behind us. Faster and more robust technology is needed to support the ever-increasing demand for more data. In fact, the biggest companies in the world, namely Amazon, Google, Microsoft, and Meta, are embracing this transition with open arms and billions of dollars. But don't take my word for it. Huang says that these companies, he refers to them as CSPs or cloud service providers, are pouring $250 billion per year into data center infrastructure. And oh, I forgot to mention that this number is set to grow at an 11% clip each year until 2030. The pie is growing large. But let's make one thing very clear. Jensen never said they have 90% of the current market share, the $250 billion pie, but 90% of the next generation generative AI and accelerated computing data center platforms. However, Jensen does expect that much of this $250 billion spending will shift to generative AI and accelerated computing over the coming years, right up NVIDIA's wheelhouse. So in other words, let's pretend you own a software company that uses AI to train computer vision models. Just an example. Well, you're a software company that wants to make money, and to make money, your software has to be better, faster, more efficient than your competition. How do you ensure that your software is superior? Well, you rely on the biggest, fastest, and most efficient cloud service providers like Amazon with AWS or Google with Google Cloud. But how does Amazon and Google make sure that they have the fastest data services? Now you're catching on. Of course, the fastest computer platform on the market, accelerated computing and generative AI, powered by NVIDIA's H100 chip. You can start to see where I'm going with this. The largest companies in the world that provide cloud services to people like me and you, small businesses and large enterprises alike, will all rely on NVIDIA's next generation computing platform powered by their H100 chip. Nice. Oh, and did I mention it costs NVIDIA about $3,300 to make the chip, and it's retailing in the $30,000 to $40,000 range? God damn. When demand for a product is high, it allows the company to have strong pricing power. In other words, the ability to price the product however they want to. And I'll tell you, charging $40,000 for a single GPU is already pretty impressive. But when considering their DGX GH200, their fully built out supercomputer that contains 256 of these chips, you could say that's some solid profit. So now we've looked through some of the basic financials, and I'm not going to spend the time going through the whole report here, but stick around till the end of the video because we will use these numbers to project and predict where NVIDIA stock might end up in the future. Now, we actually already talked about the impact of item 2 on our keys to success, and that's a deep competitive moat. What is a competitive moat? You're a European king during the medieval times, and you want to build a castle as a safe haven to stash away all of your gold and treasure. To prevent invaders from simply walking into your castle and taking what's there, you build a moat filled with alligators and dangerous water creatures. The bigger the moat and the more ferocious your water creatures, the less likely someone will be able to invade your castle and take your spot on the throne. Silly example, but this illustrates exactly the concept we are talking about, a competitive moat. Companies need to build out their moat, their competitive advantages, to ensure they can protect long-term profits and market share. And what better way to do that than selling the most robust, most powerful, and most efficient chips on the market? There's nowhere else to go. If you want to compete, you have to go through NVIDIA's H100 chips. Here's a thought exercise. Why do you buy Apple products? Why do you rely on Microsoft and Google Suite to get work done? It's simple. Their products are the best and most reliable. There are many advantages to using the Apple iPhone without even considering its own features, because it can automatically sync data between the cloud, your computer, your TV. It's an entire ecosystem that you rely on. It makes your life easier. There are direct integrations between the Microsoft and Google suites. Jump from Word to PowerPoint to Excel. It's easy to use and it's all in one place. Therefore, why would people want to go anywhere else? So remember, as we mentioned earlier, NVIDIA has captured 90% of the market share with regards to generative AI and accelerated compute data center chips. Why would corporations buy chips from anybody else when NVIDIA sells the best on the market by far. It's simple. Cloud service providers need chips to compete with each other, and the only way they can compete is if they have the best, NVIDIA's H100. However, it is certainly not a guarantee, it never is, that NVIDIA will always have the most powerful chips. They have the lead and they're certainly running away with the race right now, but their foot needs to stay on the gas pedal. To maintain this insane profitability and market share, the chips will have to keep improving. The first generation of the H100 is already in the midst of ramping up production through 2024, and the next generation is already in research and development. So obviously the chips are good and all, but trust me, it gets even better. NVIDIA's competitive moat has been strategically expanding for years. NVIDIA released CUDA in 2006, essentially their proprietary programming application that allowed GPUs to go from single-purpose to general-purpose processing. For those of you that don't know, GPUs were originally designed to perform one task, accelerate graphics rendering. But with CUDA could be optimized for many other applications, as we see with NVIDIA's Earth 2. And I encourage you to check that video out if you haven't already, because it's flat out ridiculous. Now, if programmers really want to squeeze all the juice that they can out of NVIDIA's H100 chip, they'll have to do it on their proprietary software, CUDA. Otherwise, again, their software will simply be less efficient, less powerful, and less competitive than those that do utilize CUDA. NVIDIA planted this seed a long time ago, and now it's finally coming to fruition. You want to get the most out of our chips? Well, you better use our software as well. So it's clear that NVIDIA's competitive advantages are strong right now, and their financials prove that to be the case. But what if macroeconomic environment starts to go sour? What if consumers no longer have that fat, stimmy paycheck that they used to? And what if the economy starts to slow down? Well, there's one key item that helps companies maintain strength in the face of a volatile economic landscape. Resilient products sell rain or shine. Whether times are good or times are bad, frankly, it really doesn't matter that much. Of course, there will be ups and downs, as there is with any natural business cycle, but minimizing the depth of the downs and maximizing the height of the ups is what the best of the best do so well. Apple products are bought every year, no matter the circumstances. The population is under the Apple spell. We buy the latest technology as it comes out, whether we need it or not. The brand has become synonymous with high-quality, top-of-the-line products. And I don't know about you, but sometimes it feels like there's no changes from generation to generation of iPhone. You tell me the difference between iPhone 13 and 14. Yeah, exactly. There's none. Now, there really is. There's a few differences in specs, but you know where I'm going with this. They can take the iPhone 13, call it the iPhone 14, bump the price by 15 to 20%, and voila, nobody bats an eye. And that's the benefit of having a brand synonymous with top quality products. We are at the discretion of their price tags. We buy no matter what. And I think this is a great example because, likewise at NVIDIA, Jensen has deemed this time as the iPhone moment for AI. As we discussed, iPhone generations are released time and time again, and people keep paying for them. NVIDIA's H100 is the start of a new generation of AI technology, and their customers, the cloud service providers, will continue to buy rain or shine. Like the iPhone generations from 12 to 13 to 14, NVIDIA's H100 is just the beginning, and the second generation is already being designed. And the crazy part is, as newer generations are released, gross margins grow. Scaling products in this generation by generation format allows companies to keep operating costs very low, as there isn't a whole lot of spend needed for redesign or to come up with original ideas. They simply need to make slight spec improvements with each consecutive generation and bump up the price a little bit. As demand for the products grow, sales will follow, but costs will stay relatively the same. And you know what that means? Costs are here, sales are going like this. That means more profit. Just look at NVIDIA's quarter-over-quarter sales and operating cost growth. Sales increased by over 40 times what costs increased by. That's some serious cash. And lastly, we can't forget, while we are discussing resilient products, usually it's good to rely on resilient customers, the people buying your product. I would say that most of us can agree cloud service providers like Microsoft, Amazon, Meta, and Google will be far more reliable buyers than you and I. The average person and small business are far more susceptible to debt, taxes, high interest rates, all the bad things that come with business cycles. The largest tech companies are able to navigate business cycles rather seamlessly and continue spending in times when the consumer is struggling. NVIDIA cashes out no matter what, as the overwhelming majority of their revenue comes from the tech giants. At this point, we've covered the three biggest factors, in my opinion, that separate the largest and most successful companies in the world from the rest of their peers. Now, NVIDIA is certainly no Apple or Microsoft yet, but their growth could get them there surprisingly fast. I know a lot of you have been waiting for some valuation and price target talks, so let's take a look. The PE ratio is honestly a garbage metric when considering the potential of growth companies, but we can use it to calculate the PEG ratio, which is a much better indicator for future valuations of high growth tech companies. If you aren't familiar with either of these metrics, don't worry, they are simply used to find the relative valuation of companies. Are they over or undervalued relative to their peers? And we need a baseline to compare our numbers to, so what is Wall Street saying? They always get it right? Right? Don't worry too much about the numbers themselves. I will explain what the takeaways are as we move through them. With $9.24 earnings per share, at today's share price, let's say about 480, that leaves us with a PE ratio of 52-ish. Not good. You should sell immediately. The SPY's average is 23. That's ridiculously overvalued. This world, NVIDIA. Sell. Oh shit. All right, let's hold on a second there. Like I said, the PE ratio is rather garbage for our purposes. Shows too much of the past, and we want to look more into the future. After all, NVIDIA is a high growth company. Wall Street is currently factoring in a growth rate of about 30% per year for the next few years. Using that rate, we can then calculate NVIDIA's current PEG ratio. And as we can see, it's looking a little bit better. Still relatively expensive, similar to Google actually, but less expensive than tech giants Apple and Microsoft, and way less expensive than competitor AMD. It's not even close. Let's play with this number a little bit more. Wall Street projects that revenue will not surpass $80 billion until 2026. Interesting. What did Huang say again? Something about NVIDIA having a potentially 90% market share in a $250 billion industry where the largest tech companies in the world are pouring money into year after year? Oh, yeah, okay. So what if NVIDIA can capture just 25% of this annual data center spending? Well, that would be about $62.5 billion in revenue immediately without even including their other lines of business in gaming, automotive, visualization, and honestly, this just feels pretty conservative. Remember, the largest companies want to compete, and if they want to compete, they'll need the best technology. NVIDIA's H100. So let's review. Wall Street projects 30% growth with $80 billion in revenue happening in 2026. If NVIDIA can capture just 30%, maybe up to 40% of the data center market, that's an additional $100 billion in revenue, and that could happen extremely quickly. The H100 is currently undergoing a massive scale in production well into 2024 to keep up with this tremendous demand. Assuming CEO Huang lives up to his promises of this tremendous demand and the transition to this new generative AI accelerated computing platform, their revenue will grow much faster than 30%. Let's assume that NVIDIA grows at 40%, which is definitely fair. How about 50%? That puts it right at 1. And I don't know about you, but if people were able to buy NVIDIA at fair value, at least in terms of its projected growth, I would bet you there would be some buying because it was selling at a peg of 8+ not too long ago. Ultimately, maintaining 40 to 50% growth for the next few years would be ridiculously impressive and put NVIDIA comfortably in the $800 range, maybe even as early as end 2024. Around a $2 to $2.5 trillion market cap, right where Apple and Microsoft sit today. Now, let's not get ahead of ourselves. We do need to reel in expectations a little bit. There are plenty of risks that may emerge with NVIDIA's technology as well as their financials, that could send their shares plummeting right into the dump. And let's just call it what it is. It's a risky play in the near term. Lots of potential, lots of risk. The company is pricing in massive growth due to this generational shift in computing, and living up to high expectations is no easy task. But if history is any indication, they have so far answered the bell. And if NVIDIA can continue to build upon their so far stellar track record, there will be far more trust put into Jensen's remarks of tremendous demand, and many more analysts buying into this idea of a generational transition. And now we could go on forever about other comparisons between NVIDIA and other top companies like Apple and Microsoft, but that's about all for this video. I really hope you found some value in this, and if you do want me to go through some of the risks to NVIDIA stock today, trust me, there are many, and some of their technology in more detail like their H100, InfiniBand, and their pre-built supercomputer for data centers, please let me know in the comments down below. I will see you in the next one. Peace!